Well, hello everyone. Welcome. We have some things to talk about. Are you on the fence? Do you have to make a decision? Stocks going up, stocks going lower. There are three things to talk about: rebalance, reevaluate, and risk tolerance. We've got a couple things to talk about. What we need to do is get down to business, do this pretty quickly because I want to really get through the update and speak to you from the heart. And if you're a viewer of this show, that's right, I'm calling it a show, okay? This is a financial show. Be the boss of your money because I want you to be the boss of your money, not your money to be the boss of you. So let's start the headline, the banners. Let's get into the intro. All right. You're going to want to stick around for this because we're going to learn how to make a decision. I'm not going to be here to just tell you what to do. What I really want to do is, teach you how to think in terms of managing your portfolio. This is how I manage my portfolio on behalf of my clients, and you're going to learn a lot. So let's jump in. Hey there, everyone. Good to see you. I see a few people out there. I see you, Adam. What's up? LOL autocorrect. It's all good, my brother. It's all good. Don't worry. It's, you know what? Just the fact that you're here, I am tickled pink. How about that? And thank you very much, Adam, for tuning in. So, folks, my name is Mitch Goldberg. Again, if we haven't met yet, I am a financial advisor, a little over 30 years of experience now in the industry, working directly with retail clients. That's you and me. And, what can I say? I've seen a lot of situations. I can't say I've seen it all, but I've seen more, way more than most. And you use what you've learned along the way to help clients going forward. And I am with a wealth management firm called Client First Strategy. It's called Client First because the firm puts its clients first. Very simple, right? So let's get into this. If you're a viewer of the show on a consistent basis, then you know that we always start with a quick update. And we have a lot going on. Just like every day, there is so much going on. It's really remarkable. I mean, there is more going on this year, I feel like, than the last 10 years combined. I'm not including the Great Recession because that was over 10 years. That was a lot going on too. But this just affects the whole globe. It's really just remarkable. So the Dow had a pretty good day. Overall, I have to say it was a pretty good day. It was a pretty broad-based rally. Stocks went up, then they went down earlier still early in the day, they were down. And all day long, stocks have been kind of building on this slow path to doing better until we put together a decent day. Dow up 177 points. It was off like 300 some odd points yesterday, but it was up 560 points on Monday. So far, this is shaping up to be another pretty good week. The S&P up 25 points, NASDAQ up almost 150. This is another, you have to get used to this. Like every day we're seeing another new record for the NASDAQ. This so reminds me of 1999, the year 2000. It's unbelievable. Unbelievable. Oh, God, it's unbelievable. And Russell 2000, that's a small cap index. That's up 11 points, up 0.81%. If you don't follow the Russell 2000, and most people don't, I think you should. You should get used to following that. So, that is the smaller size publicly traded companies. They're predominantly domestic in terms of earnings and revenues, and they are very subject to the whims of the U.S. economy, of the economic cycles. Large companies have much easier access to resources, like they can hit up the bond market, the stock market. It takes a lot longer to kill a dinosaur than it does to kill a minnow. I hope that makes sense. Maybe the kill thing is not the greatest example, but I digress. And the VIX, this is the biggest story of the day to me, is the VIX. The VIX is down 4.5%. Look, if the S&P or Dow were down 4.5%, that would be a big newsworthy day. But what happened is the VIX typically moves in a much more magnified way than the large cap averages like the S&P 500. The VIX is a fear gauge. When the VIX typically does go down when the market goes up. When the VIX goes down, it tells you there's less fear in the market. It tells you that professional traders, investors are hedging less. The cost to hedge has gone down a little bit. The cost to hedge your investments is pretty expensive. And as soon as a lot of people want to hedge, the cost of the hedges go up a lot. So the fact that the VIX is not only down, but it continues to be under 30, I'm going to give you the message of the market. The message of the market is that the stock market investors have made their judgment. They are aware of all the COVID positive cases in like 40 states going up. Investors have accepted the hospitalizations and 60,000 new COVID positive cases today, a new record. Hospitals becoming overwhelmed in Florida and Texas. And yet the market has gone up and the VIX has gone down. Now, we all know that the reopening phases throughout the country are going to slow down. The V-shaped recovery is, we didn't have a V-shaped recovery. We had more like a V-shaped bounce in the market and the economy, in stocks in the economy. But as far as the economy goes, it's just a bounce. And now we have to go back to layoffs, slowing down the phases, not allowing restaurants to open or closing restaurants and bars. So you start getting the layoffs again. We just started to hire people, and travel and leisure, restaurants, they were actually busy hiring, and now they're going to get busy firing again, I guess. So kind of negative. And if you look at the news, Apple Maps, driving activity is slowing again, and a warning sign for the economy. Ooh. United Airlines warns 36,000 employees of potential job cuts as pandemic roils travel demand. Travel demand. Let's talk about travel demand. It's one thing when people want to travel, but they can't because of state mandated shutdowns. But now that you basically are allowed to travel and people aren't traveling, it shows you that people don't want to travel. They wanted to travel when they couldn't because of the shutdowns, but now people could travel, but they don't want to. I think people not traveling because they don't want to, because they're afraid of this virus, is a lot worse and a lot harder to shake than people not traveling because of a shutdown. So it's a worse situation as far as I can tell. If you see the red headline up here, Bed Bath & Beyond to close 200 stores over the next 2 years, as sales fall almost 50%. Can you imagine that? Almost 50%. Okay. So let's just get that off the screen. Just another little piece of lousy news after the market closes. So let's take a look here at, before we get into that on the backdrop, JP Morgan's main strategist, Kalanovic, and I quoted him in March. He went bullish. So did I, by the way, okay. Just want to say that, but he went bullish, and so did David Kostin of Goldman Sachs. And Kalanovic has come out and said he is still bullish. He sees new highs ahead as hedge funds jump in. It could be a rocky road, but we're going to talk about what's driving things. And homebuyer demand, homebuyer mortgage demand spikes 33%. Rates hit another low. Listen, the millennials are saving the housing market. Okay. The millennials have actually saved the housing market. They're taking it over. The generation has come of age. They've got kids. They've got nice cars. They own businesses, like my man Adam, who's watching right now. Hey, Fred, how are you, baby? Better use all those Bed Bath & Beyond coupons fast. I'm telling you, yeah, all those 20% off that I have, just packed into my glove box in my car. That's right, Matt. Brooks Brothers done. I wasn't like I used to shop at Brooks Brothers. I just don't really dress as formally. I do have a bunch of suits, and Joseph A. Bank is kind of my thing. I think, did they go? I think they declared also. Yeah, so Brooks Brothers is another one. Gee, the news just gets worse. But the housing market is en fuego because of the millennial generation. And I want to show you why. What's going on? Why is the market going up with all this bad news? Here are the FANG M stocks. Facebook up 1%. Apple up a new high. Apple's going to be hitting $400 soon. Apple's market cap is what, $1.7 trillion now. Amazon is over $1.5 trillion. That stock is up $80. Netflix up almost 2%. Google up almost 1%, Microsoft a new high. When you have these six stocks going up, it doesn't matter. It doesn't matter how bad the economy is. It doesn't matter what investors, it doesn't matter what we think. Investors overall in the aggregate, Mr. Market has made up his mind. And what Mr. Market sees is when you get rising COVID cases and worries about a slowing economy because of that, that just means more money goes into these large screen stocks, tech stocks, communication stocks, screen stocks, the ones that keep you entertained. Things that you could look at your screen all day. That's what I mean by screen stocks. They keep going up. The worst thing for these stocks would actually be a vaccine for COVID-19, because if you get a vaccine, I think it takes away a lot of the impetus to own these stocks. These stocks are expected to grow to the sky. Well, they actually already have grown to the sky. Maybe now they'll grow to the moon. And, if they just stopped where they are now, the stocks would probably go down, because one of the reasons you pay up for a stock is because you expect more growth in the future. All right. You take a look at the, always look at this, the sector ETFs. Tech hit a new high. Well, the XLK, that's a new all-time high. Consumer discretionary, even financials got on board, utilities, communication services. When I say communication services, keep in mind that like Facebook, Google, and Netflix, actually just Facebook and Google make up, when I say Google, I mean Alphabet, they make up 50% of that ETF. Why even bother having an ETF if two stocks make up half the ETF? You're not really getting the diversification that you'd expect from an ETF. But I don't make the rules. I don't make the rules. I don't break the rules. I just have to follow them. Okay. And we have the laggards, building materials, staples. The fact that staples are down tells you that investors are willing to not just put more money into pantry stocks, and that's the story. So let me just show you two quick stories. Kohl's is up 9.5%. Twitter is up on news that they may be doing some kind of subscription service. All right, so that's the market today in a nutshell. That's why the market went up. We know that the economy is going to slow down. We know things are really bad with COVID. We know traveling and movie theaters, all the things that people want to do, you can't do. People are afraid to do them. People aren't really going to places. Beaches are closed. Summer, in a lot of ways, is shot to hell. I said it. Oh my God! I said that on a live stream. Okay, calm down, everyone. So that's, but the investors have made their judgment. They're looking past that. They see this as we just muddle through the economy. But the screen stocks, the big companies, the FANG plus M stocks, the M is for Microsoft, these are just going to keep going up as far as investors are concerned. And since they are really the market right now, there's no reason to not expect that to continue. The fact that the VIX, remember I said the VIX is a big story, the VIX is down. The VIX says that investors aren't really nervous. The investors are not worried about, United Airlines going down. They're not worried about another retailer going out of business. Investors have made their judgment. They don't care if Brooks Brothers went under, or if Bed Bath and Beyond might not survive. It just matters just a handful of tech stocks. Don't forget all the semiconductor stocks are doing, and software stocks are doing very well. So here's what we do. It does seem like we are on the precipice of either going a lot higher or going a lot lower. And if you take a look at the real economy and the rising COVID cases, you're in the camp that things are going a lot lower. Things are about to get worse, and we're just going to have another tumble down to the March lows, maybe even worse. I'm really kind of going on the extremes here, and or these big six tech stocks, plus the tech sector and the communication sector keep going up. So which one is it? You really have to have both. I want to know. People have said this. I want you to know. People have said this before. I've been saying this for a long time. This whole pandemic, you have to have both. You have to be diversified. You have to have the economically sensitive stocks, also known now as the reopening stocks, and you have to have the screen stocks, the stay-at-home and work-from-home stocks. You have to have both. Okay. Hey, Alex, good to see you. Matt, the MS. I'm not sure what you. Thanks, Mitch. Hey, you're very welcome. You're very, very welcome, Matt. Thank you. Man, that's nice. Thank you. Thank you. You made my day, buddy. Thank you very much. And by the way, congratulations on Tyler graduating high school. That's terrific. So good for you. Got a lot going on in the Merson household. So we have good things going on here too. But so here's the thing. So right now, if you're concerned about the market and you really feel like we could go either way, and a lot of you are not in a position where you could afford to see the market go all the way back down and stay down. A lot of you are also young and it doesn't really matter. So I'm trying to choose my words here carefully. But if you're a nervous investor, diversification still goes. That's a strategy that we use to reduce risk. Doesn't necessarily protect your account from going down, your portfolio from going down in an overall bear market. But at least if one sector gets shot to hell, you have other things to hold your portfolio up. I think you know that. Just have to make that clear. So we have to rebalance is one thing if you're nervous. Rebalance means that you have a certain risk metric to your portfolio. And it means that maybe your Amazon stock or your Facebook stock or Apple have gotten too big for your overall portfolio, which means if they go down, they have a magnified impact on the downside of your overall portfolio. And so that's one thing. The other thing is, as stocks have gone up, maybe you're a little bit light now in terms of representation in your portfolio of cash because bonds have gone up also. So now maybe you had 10% of your portfolio in cash and now it's 7% or 6%. It's time to rebalance. And then I want you to reevaluate because you may have investments that no longer make sense. You may have investments that you want to buy more of. You have to reevaluate your investments to make sure that what you have is still appropriate for you. No one has a crystal ball. You could think your investment that you have, any particular investment, is the greatest thing since sliced bread. But we could always be wrong. And again, that's where we diversify. And then after reevaluate your asset allocation, you have to decide if you want a more conservative allocation with less stocks or more aggressive. Maybe your stock portfolio, your stocks went up so much and you're comfortable with that. And you're like, you know what? I used to be 80% stocks. Now I'm like 95% stocks and I'm comfortable. If that's you, then fine. I don't want you to make your buy and sell decisions simply based on a feeling or some arbitrary number that a stock went from 100 to 200 and you have to sell. Well, a stock doubled, you have to sell. No, sometimes stocks keep going higher. And we're looking at examples like Amazon and Apple. So I don't want you to make your decisions based on a feeling or an emotion or some arbitrary number. I want you to make your buy and sell decisions based on your risk tolerance, based on what your risk tolerance says, how much you should have in stocks, bonds, and cash. Which brings me to the next thing is your risk tolerance. Because ultimately, if you're really worried about the stock market going down because it could hurt you, because you're of a certain age where you don't have so many years ahead of you, then what you need to do is understand that time horizon is the main determinant of your risk tolerance. The longer your time horizon, the lower your risk tolerance. And you have to really make sure you know what your risk tolerance is. And if you say, I've made all this money in these stocks, the Facebooks, the Amazons, the Apples, I'll throw in Tesla. Okay, we'll throw in Alphabet. We'll throw in plenty of these companies that have gone up tremendously just since the March low and year to date. And if you can't take a reversal in these stocks, you have to wonder if they're appropriate for your risk tolerance. So let's just take a couple of comments out there. Yes, Fred, nice way to say that I am old. Hey, I'm right behind you, buddy. And again, happy birthday to you. And thank you very much, Matt. Hey, Alex, good to see you. We already got Adam up there. So that's really about it. I want you to make your decisions not because the market's up too much. And I want to really be clear about this. If you make a decision right now, you're just going to skip over things. You're not going to wonder or you're going to ignore things. then you're making a conscientious decision to do nothing. And that's okay. Doing nothing is a decision that you may make as well. Maybe you're waiting for more information. Maybe you're waiting for a break in these stocks. Maybe you're waiting to see how the stock market's going to go. Maybe you're waiting to see if we get better news on the COVID front, on the pandemic. I have news for you. If we get really good news on the COVID front, a vaccine, for example, comes out, and you have these large 6 companies, which we've already identified at the top of the show. If they go down, they could drag the whole market with them, even if you get a pop in industrials and energy and materials and financials. So it's not necessarily the greatest thing for the stock market. You see how that works? The stock market works sometimes in very perverse ways. Okay, so I'm going to leave it there. I wish you all the luck in the world. If you have any questions that are more specific, about your own portfolio, your investments, what to do next, your financial plans, etc., you are welcome to reach out to me directly. I'd love to hear from you, and I'd love to hear from you if you don't have any questions. Okay, I'm going to end this broadcast, and I'll see you tomorrow. Thank you very, very much.